Good afternoon and welcome to RiskScout's monthly webinar. RiskScout is committed to providing insightful, thought-provoking content to bankers interested in starting and growing new business lines at their financial institutions. We provide a mix of personal and professional development to give you the tools you need to be successful. My name is Amanda Sandoval and I'll serve as your moderator today. And joining me on this webinar is Kristen Parker, Director of Compliance for RiskScout, Rita Ward, Chief Operations Officer with RAD, and Elizabeth Slim, Founder and Chair of ACAM's Southern California chapter. I'm so excited to have you ladies on the call today, and their combined expertise in this area of progressing markets should make for a worthwhile webinar. And this month's webinar is entitled Assessing and Managing Risk of Traditional Higher Risk Clients and Customers. Well, following the webinar, all registrants will receive a link to the recording via email, and our presenters will leave some time towards the end of the hour for our registrants to pose any questions you may have. If you have a question you'd like to ask, please put it in the chat box in the lower right of the corner screen. And I think that takes care of all of our items. So Kristen, I'll go ahead and give it over to you.
Sounds good. Thanks, Amanda. I appreciate you. I am really excited to be here. It's always really fun to get to do webinars with your partners and your friends that are super smart and ready to share their knowledge. So just to give you guys a little bit of the background, I'll start and I'll let Rita and Liz give their backgrounds as well. I'm Kristen Parker. I'm the Director of Compliance at RiskScout. I have been in banking for 2 decades, and most of that focus has been on BSA AML compliance. I started and launched some of the early hemp programs that were out there after the Farm Bill passed, but I've banked about every type of higher risk client base under the sun, it feels like. So I definitely have that kind of cheeks in the seats experience of understanding the pain points of banking these and these type of industries or individuals that can be deemed a higher risk or require more touch points from a regulatory standpoint. So it's going to be really good for us to go through this together because I can definitely empathize and sympathize with probably a lot of you folks that are on here, and we'll be able to hopefully share some best practices to help everybody streamline their dealings with these type of businesses or individuals. Rita?
Awesome. A great background, Kristen. It's great to have a partner like you in this space. I'm Rita Ward. As I said, I'm the Chief Operations Officer at RAD LLC and RAD CAN. I've been in the banking and finance sector for 20 years. It may not sound like it, but I have been. I have my CIA, my CRMA, and a couple other acronyms that solidify us being in the compliance space and being a professional. I've worked with all type of high risk accounts, MSBs, money transmitters, ATMs, cannabis, hemp, pooled investments, you name it. I've had a luxury of experiencing it, both on the finance side and on the regulatory side when I worked with a couple of entities. So with that being said, I hope I can bring some of the insight from seeing it full spectrum to this webinar. And I'd like to hand it to Liz at this time.
Well, thank you, Kristen. Thank you, Rita. I'm Liz Slim and the founder and chair of ACAM's Southern California chapter, but I've also been in the banking industry for over 35 years. Actually, it's almost 40 years. But similar to Kristen, I became a BSA officer when nobody knew what a BSA officer was. So that was growing pains for everybody, but no regrets. I've been in community-sized banks and mid-sized banks. So it was very rewarding and interesting to dedicate the last, I would say, 15 years of my profession as a dedicated BSA officer and continue to watch this industry grow. So like Kristen, I know everybody's pain points. I understand the challenges you all have, and being here in Southern California, we're high risk no matter what. We're a HIFCA, we're a HITA, and we've got the transnational organized crime syndicates in California. So we see it all. So hopefully with that experience, I can share, any insights with everybody. So I encourage you to ask questions. And also on a side note, I want to say yesterday was National Compliance Officer Day. So hands off and applause to everybody in the compliance industry. It's a tough position that we're in, but somebody has to do it. And I know that our efforts are meant for the common good. So congratulations and continue the good work out there, everybody. Okay, Kristen.
All right. Thanks, Liz. Thanks, Rita. This is a jam-packed information-full webinar, so don't get overwhelmed. There's a lot of good information on these slides, so we always, again, we send the webinar recording out, but if you ever wanted to just have the slides for your taking and your digestion for use at your own institution, you're always welcome to reach out to me directly, and I'm more than happy to share. None of us get any of this stuff done alone, so we might as well be a team together and share when we know things will benefit others. So for our agenda today, we're going to talk, we're really going to start at what is a higher risk business? What is that? How's that really defined? And we use the word higher risk because there's different connotations to high risk. Just because they are maybe deemed high risk by, FinCEN or other regulations that are out there, doesn't mean that they necessarily all present the same type of risk. So we'll kind of go through all of those pieces of the puzzle of what defines truly what a high risk business is, or individual for that matter. We're going to talk about how traditional markets are evolving to become higher risk. We're going to go through the pros and cons of maintaining one of these higher risk portfolios and really best practices for informing key stakeholders about the known or perceived risks or opportunities for banking these types of individuals or businesses. Regulatory requirements for banking higher risk businesses is important to know. We're going to talk about making those regulations readable, digestible, in human language, and ways to really meet those expectations in a realistic manner. We're also going to talk about ways to ensure your new and existing high-risk clients fit your financial institution's risk appetite. So I want to start off by defining what higher risk means in relation to banking. So when we talk about higher risk, we're just really simply talking about individuals and businesses seeking financial services that may present an elevated level of risk for potential illicit activity. I can also add here that they require, from a regulatory perspective, potentially more touch points, more requirements, and more effort in really understanding your client long term. So we want to hone in on the fact that you are banking these higher risk clients. That comes with responsibility, right? And that includes additional CDD, customer due diligence, and EDD requirements, enhanced due diligence above and beyond your standard client to really understand what this business or individual does and what their activity may look like, and then ensuring that you understand that the activity that is occurring in the accounts and is truly commensurate with the stated nature of the business. Rita and Liz, you got anything that might be helpful to add there?
Yeah, I would like to jump in really quick and hand it over to Liz. You'll think about high risk accounts. You're like, everything's high risk. And you're like, what is higher risk, right? Your definition was really good that you gave, but I want to give some examples, such as a MSB that has multiple transactions that are going into the millions on a weekly. That's a higher risk than what a normal MSB would do for you as a check casher. Let's talk about the cannabis transactions, right? You have a cultivator, which we know that their harvest is every 3 to 4 months, but yet they're doing deposits in large numbers every 2 months. So then you want to look at what's driving that because you know the nature of the business. And the same thing with the check casher. So those are things that you really want to hone into when we're saying higher risk. Because I come from the background of you sign it, you own it. So you really want to know what you're owning once you take this on. I'll stop there.
And I agree completely. Higher risk involves, not just your clientele, but the products and services that they use. And then you have to consider higher risk transactions. So you might have a homemaker where all of a sudden you see ACH activity has increased tenfold, and then it's the name of a homemaker. And before, this homemaker was low risk, but now the activity deems potential high risk activity, and maybe designating this customer as high risk. So there's a lot of factors involved to consider that, what is higher risk, and what was okay yesterday may not be okay today. So you have to factor in a lot of considerations. And again, we always talk about a risk-based approach as well. And this shouldn't be new. As Kristen stated, we are now obligated to conduct customer due diligence. And just customer due diligence means identifying your customer, collecting information about what is their source of wealth, what is their occupation or business, who do they do business with, what types of, what is their source of wealth or income. We have to collect that information as normal customer due diligence. And then to elevate it to enhanced due diligence for those higher risk customers entails a lot more information and documentation you have to gather. So there's more differences there, which we will continue to discuss as we go along.
So we probably want to put a face and a name to what higher risk is. And the reason we call it traditional in this slide is because these are potentially businesses that have been, or types of individuals that have been around for decades, right? Independent ATMs, money service businesses, various cash intensive businesses like convenience stores, jewelers and precious metal dealers, non-resident aliens, and other varying type of individuals, politically exposed people. And politically exposed people doesn't just start at the person who's in office, it goes down into their family, and they're well-connected individuals. And that doesn't mean just a politically exposed person like somebody at a national level holding an office. That means down to the nitty-gritty of understanding, politically from your local standpoint. Maybe it's your city council, maybe it's your mayor, understanding and assessing the risks of potential activity that may occur in their accounts because they are politically exposed people. Maybe they are more susceptible to bribery and potential other illicit activities. So it's really important to understand your customer. So these are traditional in the fact that they also are in everybody's community. Nearly everybody's community. I hate to even put the word nearly here because they really are in your own backyard. So really understanding and starting with understanding your demographics, which we'll dive into a little bit later in here. Understanding who is in your community will help you understand the risks of banking those just general population of your footprint.
Kristen, I know that, with PEPs and you went into like your local Congress or city council members. Now, remember, the regulation addresses foreign PEPs, not domestic PEPs, but there is a lot of talk about looking at your domestic PEPs as well. So just wanted to state that as clarification.
Absolutely, absolutely. Rita, anything you want to add to this?
No, you guys covered it well. List what I was going to talk about.
Perfect. Now, we definitely want to touch on the fact that some traditional markets on this slide are becoming more evolving more as time goes on to adapt to the changing markets and the changing demands of consumers. So we'll take ATMs, for example. I can speak from an example, and we were recently in Washington, D.C. for a conference, and we went into one of the oldest restaurants in D.C. for dinner, and there was just this little mom and pop ATM, independently owned ATM, just sitting in the corner that nobody would ever really notice normally, but on the screen popping really, really loudly in big bold letters was purchase your digital currency here, purchase your Bitcoin here. And people aren't realizing us as bankers are not doing a good job at being able to keep up, or maybe we're not doing as good, you know, from my side as educating that these markets that were once traditional higher risk, that are everyday businesses that have been around forever, are evolving to become even more higher risk over time, because that ATM owner now sells digital currency through there. They technically qualify as a money service business. So there's different requirements involved with that, different due diligence efforts that needs to be involved in really understanding the nature of what that client's activity is going to look like, and understanding the safeguards that they have in place to adhere to their responsibilities as a money service business. So traditional is evolving, and you need to be aware of that. Best practice because of this, if you are banking ATMs currently, is you should be doing some type of due diligence on them after your client on some reoccurring basis anyway. But this needs to be part of it, is really understanding, has the services that you offer at your ATM changed or evolved, and help me understand that, so you can understand your responsibilities as an FI for understanding that your customer is doing the right thing.
I agree completely, Kristen. This is Liz. I was surprised. I'm walking through the mall in my city, and right there against the wall, it's a small kiosk, but it's a Bitcoin ATM. I had to stop and take a picture of it. I said, "Oh my God, I know that these are prevalent," but I was a little surprised. But for somebody that owns that ATM, you definitely need to look at the electronic transactions. Does it make sense? Were you aware of it? Did they say they were an ATM owner? So you should see, normal withdrawals and purchases through a debit card, but all of a sudden, if you see cryptocurrency being purchased, then that's a red flag to, really conduct your due diligence. So, really watch for the increased transactions. And again, this is where I say you have to consider higher risk activity, which could be the red flag to, do a deep dive on your customer.
Yeah, and just to touch on that, I truly believe the refresh of the due diligence is key with this, right? With the information. Because if you're not touching bases with your client and asking them about these transactions and asking them about the landscape of their business, you won't be able to modify your application or your checklist for monitoring to capture these activities as the industries evolve.
Yeah, absolutely. And just so that you guys are aware, anybody can purchase the software. So it doesn't have to require these ATM owners to go purchase a brand new ATM or rent a new ATM. They can literally just plug and play this software, and it's available. So just an FYI, not to scare you, and not to say that what they're doing is wrong. They may have checked all the boxes that they need to, but that's your job to understand and ensure that that has occurred.
Well, first thing that comes to mind, then they're money transmitters. And are they licensed? And are they aware of it?
Oh, Liz, get out my brain. That's what I'm thinking next too.
Yeah. And so we talked about traditional, and that's really the focus of what this webinar is about today, but new and emerging higher risk markets. So ones that are probably in your community, or at least living in the infrastructure digitally all over the US, crypto, fintech, different payments, cannabis, gaming, hemp. We could probably make that list go on and on and on. These are different risks because they're not so well understood yet either, right?
Mm-hmm.
They are newer. It's kind of like when I launched one of the first hemp programs in the US, there was nothing. I did it 3 months after the Farm Bill passed, because the demand from the top was that we were going to do this and we were going to be the first to do it. So I took every law that I could find, local law related to hemp in the footprint we were in, and just kind of deciphered and understood the industry and built it on my own. And it worked, but it matured over time as we learned more about the industry. So we finally, a year and a half to 2 years later, got some type of guidance from FinCEN. So these are newer markets, and they're higher risk because we don't quite understand, and they haven't, much like traditional, haven't quit evolving, and they won't for quite some time. And it's going to take a long time before your regulators know what's going on, before FinCEN knows what's going on. So it's this game of trying to give them the ability to bank somewhere so they can grow their business, but also understand the risks associated with that and how to mitigate those risks.
Well, that goes into your monitoring, right? What your process is in place today and your workflow for monitoring may not be what it needs to be in 2 months from now. Because as these industries continue to evolve and merge and they get these plug and plays and add-ins, it's more risk, right? And sometimes we're not notified of those changes. We become aware by just simple conversation, or we're on the online ourselves and we notice these things. So our monitoring is always going to evolve and grow as these industries continue to be here.
And just also look at, current situations. I mean, we just went through the COVID, issues, and there's so much COVID fraud now that's being recognized. So that should play as well into emerging risk in terms of COVID fraud. But another thing in the back of my mind is that FinCEN continues to issue the geographic targeting orders, the GTOs, which are in the mega cities, New York, down in Florida, California, even in Hawaii, where do you have clients situated in those areas? Are they title agents, real estate brokers? Are they doing business in any of those designated high risk GTO areas that you need to also watch out for? The payments, the P2P, person-to-person payments, Zelle payments. A lot of banks have jumped on the Zelle payment bandwagon, but that fraud has been increasing too in numbers, especially with the larger size banks, like the Wells Fargo and the B of A's. There's so much fraud conducted through Zelle because you've got a lot of these fraudsters that just, take advantage of students and unemployed people to make instant cash. So there's other designated emerging risks, as which is new, or maybe a version of an old fraud.
Yeah, 100%. One thing to keep in mind here is that, I mentioned it in the beginning, but I will probably repeat this throughout. Not all higher risk businesses and individuals are created equal. They do not all present the same amount of risk to your institution. So it's important not to blanket statement a risk statement to an entire industry sector. If you say, I am never going to bank cannabis at my institution, first of all, you probably already are if we all just want to be truthful about the matter. And they've snuck in under the guise of maybe a regular business, or maybe they already were an existing business customer at your institution and then they swapped over to being a cannabis business. Or either way, we'll talk about that later. If you said you were never going to bank cannabis ever, and you presented the same amount of risk like anybody involved in it, then you're really cutting out potentially big factors and big clientele, and you are potentially cutting out profitable businesses that could be banking at your institution because you've made this blanket risk statement that I don't bank that at all, but you aren't thinking that maybe your local power company is the one who's supplying the lighting for them, not because they want to, but because they are a customer of the power company, because that's the only power company that serves that area. Local lighting companies, all these ancillary businesses are non-plant touching, directly involved with the plant itself. Businesses support that industry. If you're not going to bank the cannabis industry at all, that statement means everybody involved in it, and so it's important not to blanket statement the risk of a certain industry altogether or certain businesses involved in that industry. It's really a case-by-case scenario of vetting them all to individually to understand the true individual risks of those businesses within that industry sector to your institution.
I concur. It's so easy to create your policy saying that we do not do businesses with these types of entities or products, such as cannabis or casinos. And as you stated, you might be doing business with them indirectly. One common one is, providing a a loan to a commercial business owner who has leases on the property. And guess what? That lease is for a dispensary, a cannabis dispensary. So there's already a direct tie of, indirectly banking cannabis right there.
Yeah, and I put some examples on the slide for you guys to think through. An MSB, I used to have a big MSB portfolio at an institution I was at, and I had one that was just, in a mom and pop flower shop. Maybe they cashed, $2,000 worth of checks per month. And then I had an MSB in a pawn shop, and that was a very different risks involved in both of those MSBs. It's kind of like what Rita said in the beginning, and an MSB that's doing little amount of activity compared to one who's doing $1 million a month or more present very different risks to your institution. A hemp broker, for instance, the hemp is deemed higher risk, even though it's becoming more commoditized over time. There's still risks involved in making hemp. A hemp broker is a little less riskier than a hemp retailer because a hemp broker never touches the plant and is literally just making the connections between the grower and somebody who wants to buy it. And they're playing that middleman. A hemp retail shop is slightly higher risk because you don't know what they carry on their shelf from day to day, and you don't know if it's violating any local or state laws. So it's just, again, to reiterate that just be mindful of that blanket statement risk. Because not all.
Totally agree. I agree. I actually have an example of an ATM business that had physical ATMs, and then they segued into the cashless ATM sector. And the first thing I asked, I was like, are you compliant with Visa and MasterCard disclosures? And are you compliant with FinCEN? And they were like, what? We didn't know that we had to do that. We just flipped a switch. It's our new business model. And I recommended to the client to let them go immediately, because that's a different type of risk when you go cashless, especially when you're going in a place of a jewelry store or a dispensary. You have to look at those and you have to really digest that and see if that's the type of business you want to take on.
So the biggest thing we can say here is that you are probably banking higher. No, not you probably are. You're banking higher risk clients, whether or not you've acknowledged it or not. They're in your institution, and to say they're not is probably could be considered willful blindness in a manner, because there are clients that present different risks. You may not be banking the ones that were on those slides per se, but you are banking businesses and individuals that pose additional risk to your institution. So what do you do if you say, no, I don't, or I'm not sure, what are you supposed to do to identify them? A lot of institutions, and some institutions I've been at, we use hot topic keyword searches for high risk activity. Sometimes we'd pull lists and run client names, and we'd look at the transaction activity. It was really important, ACH and wires. ACH hot topic words would include something around ATM settlements, other high risk activity. We were able to identify a ton of MSBs that we didn't know existed there. And then same thing when hemp rolled out. All of a sudden, all these hemp people came out of the woodwork and say, oh, I've been here for a while doing this. And we're like, it's really kind of gut wrenching when you find it, because you really have to do some soul searching of how could we have done that better to really identify them to begin with, or identify them after, in case their business model had changed. Reviewing the volume activity occurring in a client relationship and determining if the activity is commensurate with the stated nature of the business or individual's occupation is a good way of determining whether or not someone is truly operating the type of business or has the type of employment that they say they do. That could be a red flag that makes you kind of dig in deeper to say, okay, this does not look like it is an actual ice cream shop or a therapist office. There's definitely activity in here that doesn't line up with that. I need to investigate further. And then consider investing in reverse search engine technology to identify higher tiered risk activity. There's some companies out there that offer lists of businesses and individuals associated with higher risk businesses. You could scrub those lists potentially against your own list of clients to identify any red flags that may potentially come out. Important things to keep in mind is that risk is not static and customer activity will change over time. It always does. Not all higher risk businesses, again, or individuals present the same type of risk to your institution. And if you fail to identify high risk customers and properly segment them into higher risk categories, that can be part of some big gaps in your BSA AML program.
You know, I want to share an example. When I was a BSA officer at a community bank, this was years ago, but our AML monitoring system detected some unusual ACH activity in a customer's personal checking account as well as savings account. And the unusual ACH activity actually was US government checks in third-party names being posted to the customer's checking as well as savings account. And the savings accounts were in the names of their children as well. So I would have, you know, John Doe's US Treasury check of 500 posted to the checking account. Another Jane Doe's would go to the child savings account for $1,000, but I would always see a debit of $100 less come out. So to me, that tells me, okay, and this was around tax season time. So here's this individual, you can assume that they're conducting, you know, tax preparation reporting and using their personal accounts to help these people collect their money electronically from the government and collect $100 prep fee and give the rest back to their client.
Yeah.
You know, it's something as simple as that, but you know, nothing's really that simple. You just have to pay attention to the volume of activity, because the volume of activity will create a higher risk transaction.
Absolutely. These are really tips for identifying new higher risk clients that come into your institution. So how do you stop them, and how do you really understand prior to onboarding them? So really, it starts with equipping new account staff with the right tools to successfully identify higher risk individuals and businesses prior to onboarding. If you don't give them the right tools, they're never going to either care enough to identify them or know how to identify them. They have to have a step method to being able to uncover and discover these clients prior to onboarding, so they can be routed to the proper party, maybe it's the compliance BSA department, to vet those businesses and individuals prior to giving them the green light to bank with you. You really should consider investing in a customer due diligence verification tools to really ensure that your prospect customer is who they say they are. We work with a lot of institutions that have high volume applications, and RiskScout does due diligence reports on behalf of our clients so we can help them vet and understand who they might be banking. We never tell them whether they should or should not bank somebody, but we want to be able to give them the information to make a better, more risk-based, informed decision about whether this potential client is going to fit their risk appetite or not. The people who apply at some of our institutions lie. And they don't tell the whole story.
Is that true, Kristen?
I mean, people lie.
Are you sure the gardener doesn't make $5 million or the hairdresser doesn't make 1.2 million? Are you sure?
And not only is it that, you know, they're not truthful maybe about their occupation or really the true nature of their business, about how far deep it goes, but it's also adverse media monitoring in there too. Is this person or this individual showing up somewhere, somehow, in some type of that news segment over time that uncovers that they've been involved with illicit activity in the past, or maybe present a potential reputational risk to my institution? So it boils down to having the right tools in your pocket to really truly route and then verify the businesses are who they say they are and look for red flags prior to giving the green light to work with your institution. Again, you know, with things to keep in mind, if you are saying that you don't bank higher risk clients, we have seen more and more regulators going into institutions expecting you to prove how you know you're not. Nobody ever wants to be caught saying they don't bank higher risk clients and then the regulator finds them while they're there. That's a terrible conversation to have. Really going back, and I've said this before, but understanding the demographic of your community is key to understanding the risks of who wants or needs, not or needs, and needs to be banked in your footprint. That's super important. I can't tell you how many institutions I talk to still that are like, well, I'm not going to bank hemp because it's not legal. It's been legal since December 2018. This is almost, what, 4 years later, 3-4 years later? The fact that we as bankers have the ability to stop businesses from banking there because we simply don't understand them is really sickening in a way, because we are the ability to let people grow and thrive as a business if we choose to understand really the true risks involved with that industry and that business, and if it fits your risk appetite. If you're not even taking the time to evaluate it, then you are turning away businesses that could help your institution grow, and you're not being a good servant to your community. And if you're a community bank, that's definitely the wrong approach. Higher risk individuals and businesses will find a way to bank somewhere, even if that means under the guise of a low risk profile. So if you say that all of the institutions in your footprint say, we're not going to serve any of these type of industries or individuals, they're going to find a way to make it into your institution. So you might as well put the safeguards in place to make sure you understand and have a way to vet these businesses, and then have a way to manage the ongoing compliance efforts that are associated with banking these businesses and individuals.
Kristen, I want to jump in on this one. It's very key what your training and your tools and your equipment and resources that you give your team. But I want to take a half a step back and say, certain individuals you want to look for to work in this area in the bank, right? You want someone who has an instinct to smell when something's not right, who has that investigative gene in them. You have to do more than just do your job role when you're assessing high risk or monitoring it or onboarding it. You have to almost be a detective along with being a banker when you're taking on these accounts.
Yeah, you're right.
I agree. You have to have that inquiring mind. Why are they doing this? Where is this coming from? To ask those questions, because you have to do that deep dive to really understand what they're doing, where the money's coming from, and who they're doing business with to get that comfort level. Getting the right people with the right skill set is highly important. But then again, you have those people too that have the skill sets. I just wanted to share I read a recent enforcement action from the New York DFI when they indicted 2 individuals, and they were compliance officers. One was a CAN certified anti-money laundering specialist, and another one had compliance training. They were both trained in compliance, but they funneled about $1 billion of illicit funds through cross-border transactions, and they did not institute a robust BSA AML program to file the SARs, because it was all for profit.
Wow.
And you know what, Liz, I might be opening a can of worms with this by saying getting the right individuals there. And then the first thing I think everyone on the call is saying, hey, I may not have the budget for that.
Which is true too, but you have to, put it before them. You have to, do that staff analysis. I read somewhere where, create a risk assessment report where you identify, the risk involved with, say, this new product, a new marketing product that was just rolled out without your understanding or knowledge, or the fact that they're bringing in this new product or new clientele, and you state you need the resources, whether it's both human, you need staff, and you need technology to support the risk. So you identify it in this risk form and present it to your board, present it to management, have them sign up on it. And if they don't, then file away and say that, I tried. When the regulators come, if things happen to go sideways, you can always, say, I tried addressing it and I didn't get any response. Here's the email, here's the format of where I identified all the risk, and how to manage the risk. These are the threats imposed, these are the resources required, but the board, just let it pass. They wouldn't support it at the time or continue to support it.
And when it comes to these systems, I always tell them to look at their different options because there's a lot of varieties. But when it comes to staffing, if you can't take on FTEs, you can always look at firms that provide fractional support with these particular areas as well.
That's so true. There's a lot of expertise now within those third-party supports.
Yeah, absolutely. So there's always pros and cons to everything, but we've got some pros listed here that are things to consider for banking high risk clients. That would be fee income revenue. A lot of these type of industries are dying to bank somewhere and they'll pay for it. Deposit reserves. Deposit reserves are really important, especially if you're banking money services businesses. You got to take into account returned checks.
And their cannabis industry. If all of a sudden you take on cannabis as well, and you decide at a later date you're exiting either one client or you're exiting the entire portfolio, does the board and your bank realize when you exit them, you have to return those deposits? When we're talking cannabis, we're talking millions of dollars. Can your bank afford to provide that money back to that client without going under? And then in terms of MSBs, Rita and I know we've seen this with banks that are entering the MSB environment. They forget about other risks such as check fraud and endorsement risk issues, and having the reserves, because we know an endorsement, a fraud endorsement, can come back to you 3 years after it was negotiated. Do you have the reserves to collect on that check? And we're not talking, a $100 check. We can be talking thousands and thousands of dollars.
Yeah, we saw hundreds of thousands. And it was astonishing to me that the institution did not know about the 3 years. But those are things that we have to factor in when you think about reserves, right? The reserve is there to protect you when you choose to take on this product, when you choose to take on this risk. And you have to properly budget that along with the fee income to make sure you're covered.
Yeah, and then low cost deposit sources, new asset growth, new market, new asset growth. You differentiating yourself from larger financial institutions. The big guys out there don't want to take on this risk. They're banking them. I know they are. I've had people tell me that I'm like, where do you bank? Oh, I bank at Bank of America. Oh, they definitely don't know you're banking there. Because once they catch wind. So it's a good way to really also serve your community needs. The cons include potentially more time and effort to manage these traditional clients or traditional high risk clients. Again, back to the employee talk, needing the skilled employees to do it. You cannot get your teller that you just turned into a BSA officer to run a higher risk banking program. It needs to be somebody who, it either needs to be folks that you have a little bit of understanding under the belt of the true risks, and you also got to take into consideration that you have the ability to partner with vendors that will help you guide and get that information you need to run a high risk program. So it doesn't mean you necessarily need a cheeks in the seats person all the time. That's as skilled right out the gate. There are ways to get them employed, and there's fractional help. Just like everybody was talking about earlier. The potential increased risk of default or loss, potential reputational risk. There's a lot of conservative people in areas where cannabis is legal. Do you understand your customer base and how they're going to react if they find out that you're serving the community? the cannabis community. And then, we put deposit reserves on the pros, but we also put it on the cons because, ladies, you want to take that one?
Pricing is key. You want to make sure that you price it correct. You don't want to underprice the product and then your expenditures are not being covered. And then if you have to exit out of it, you do not want to take a loss to your reserves. Pricing is key.
Oh, I have had, in the past, I've had several conversations with marketing and with the sales teams because their job is to bring in new business. Their job is to think outside the box. It's like, how can we bring in new business, create revenue, and they get creative. And I said, as a compliance officer, as your BSA officer, I will support the bank's vision and whatever direction the bank wants to go. However, just factor in your pricing the cost of resources to help monitor this risk area. And when I put it to them that way, that, bring it on, but you have to remember, you have to price this new product or this new client in such a way it'll offset the cost of monitoring, so we don't lose we don't lose our reputation, and that we don't get fined by the regulators, etc.
So let's talk through some foundational steps for building a higher risk banking program. And if you already have one in place, these are good pulse checks for you guys to say, okay, am I doing really what the regulators expect me to do, what industry experts are doing that are already banking this? And it doesn't have to be this exacerbated process. We can really step through this methodically, and once we really have broken it down like this, it's really achievable. So if you already are banking these, or you discover some and you don't already have a program built, it's really, with maybe potentially a little bit of hand holding, but with this roadmap, it gives you the best practices for really beginning and launching a program. So we talked about this several times already, but really understanding the market. And that goes not just in understanding your footprint, but in what individuals or businesses live there, but researching other financial service providers in your area to understand who may or may not be serving these type of businesses or individuals. More often than not, other financial institutions are willing to talk to you about the pros and the cons of banking it, the lessons they've learned, so that you don't make the same mistake. There's enough of these higher risk businesses and individuals to go around. Not one institution needs to be serving them all. So they're willing to really spread that information education wise. And I say financial service providers because it's not just banks, it's not just credit unions, but sometimes in your area there are maybe financial technology providers or banking as a service providers in your area that aren't necessarily a traditional credit union or bank. It is some other service provider that is maybe providing some type of financial services to this industry outside of your traditional banking market. We also really advise on considering looking outside of your footprint to other areas your financial institution may be interested and willing to serve. If you have the right tools in your pocket, the right technology, the right processes and procedures in place, your FI can look beyond just traditionally serving your traditional footprint that you're used to. You need to seek out the individuals from qualified and certified subject matter experts in the market you're interested in serving. Don't be careful where you get your information from. Just because somebody has some alphabet soup after their name doesn't mean they necessarily know what it's like to build a program, run a program, or advise on a program, or even understand the industry at all. So just vet who you are seeking out information from, and really understand how you should price your program. That goes back to talking to other financial institutions too. Really understanding if they are serving, what are they charging? What's their ROI? And you really need to be passing on that cost to the client.
And talking to your peers and other financial institutions, when it comes to, I would say, the compliance world, those people are willing to share and talk to you because they understand, the issues that we face. So we're more willing to talk and share information, I would think, than others. And if not, go to, some of the professional organizations as well as a resource. Going back to demographics, within your community itself, you also have to understand, where's the high risk crime areas. Like we have some criminal organizations here in Southern California where there's pockets in certain areas where we know that there's healthcare fraud, where there's, other types of risk and fraud that we're aware of. So even though your bank as a whole is a moderate risk, you have a pocket here and there where it's high crime rate because of certain transnational or criminal organizations. So you have to factor that in.
Absolutely. Then we move on to the risk assessment. After gaining an understanding of the market you wish to serve, you need to complete a risk assessment that is specific to whatever that industry is, whatever that market is. A general BSA risk assessment is not going to help you through this process. Risk assessment should always cover the inherent risks, what your risk mitigation internal controls are going to be, and your risk mitigation plan for whatever you've identified your gaps are. A gap analysis will help you really understand where you need to obviously fill the gaps, right? You compare it against your existing program and where you desire it to be. And the risk assessment should really be used to help define your risk appetite. And when you're really understanding this, where your gaps are, and truly, risk assessments are painful to go through. Let's just all tell the truth. But they are so valuable because they give such good information at the end to really tell a good story about where you are and where you want to be and what you need to fill those gaps. When you understand where those gaps are, you make the plan to fill those gaps in. But you need to be really setting program limits to begin with. How many of these businesses or individuals in a certain market are you willing to serve to get your feet wet? And then what is your process for identifying how many businesses you do have on board, and when will you notify the appropriate key leaders and individuals of not when you hit that max, but when you're approaching it, to say, okay, I believe, this is the lessons learned from businesses that we've onboarded. Here are other gaps we've identified that were not in the risk assessment that we wouldn't have known until we actually opened up the program. If we want to continue heading in this direction, I need XYZ to do so. Or everything looks great, I think we can open these up to another 20 clients. So a risk assessment should at minimum address the legalization status. This is really important in the THC cannabis MRB world. Product lines and services, you need to address what's going to go on with the deposit relationships. Are you going to lend to these? Identify geographic locations that may pose a higher risk. Liz has touched on that quite a bit. We're going to assess the risk of the customers and entities, such as services sought and geographic locations. Are we really, the services offered may be different based on the risks associated with that individual business that you're offering services, banking services to, and suitability, regulatory health, enforcement activity, BSA AML audits. Did your board buy in? Do you have the right staffing? Do you have the right technology? I'm going to tell you the truth. I tell people, don't be me. Don't try to get into a high risk program or manage one without the right technology. I've tried it. It's not successful. It's not pretty. Suspicious activity, understanding what your requirements are for all those other regulatory pieces.
Just a quick note, for risk assessments, I think we all know you need to update it at least annually or when there's a major change, such as a new product or service is introduced, or new client portfolios being taken over. So make sure you update it. Once you create your risk assessment, though, then you did the hard part. You collected the data, you created all your fields. Then it's just a matter of update it on an annual basis. And remember, you want to do quantitative and qualitative reviews. Collect the data, review the data. So say you have 10,000 customers, what percentage of that is your high risk? So then you know how to monitor for your high risk customers based on the risk assessment. I know that we have 5 minutes left, Kristen, so maybe we should jump quickly through the other slides.
Yeah, I'll jump quickly through them, and maybe we'll have a minute or two for questions at the end. Policies and procedures. You want to have policies and procedures for your high risk market you will be serving. It's not a best practice to have it tied in with your just general BSA AML compliance policies. You should address policies that exist in other departments and not just BSA AML compliance. Address how you're going to listen to other line of businesses that may be involved, lending, treasury management. You don't want to over design your procedures. It's not your responsibility as a financial institution to police these higher risk markets. We are charged from FinCEN and our regulatory agencies to have a risk-based approach. That doesn't mean you have to police every single transaction that comes in there. You don't want to over design your program and it not be achievable. That's when you get in regulatory trouble. Your policies must be reviewed and approved by the board of directors. And you should have your procedures should be repeatable and consistent. Again, do not over design your processes.
And do not include procedures in your policy as well.
Yeah, don't do that.
I have seen that so many times. Now, remember, folks, if procedures are included in your policy and you change the procedure, even if it's one minor step, then the board has to approve it all over again. So keep the procedures separate from policy.
Absolutely. Communication best practices with key stakeholders. Your key stakeholders are your board of directors, your executive and line of business directors, and your regulators. Regulators want to know when you're exploring new or higher risk markets and other services that you may be offering. Involve them prior to launching, or if you already identified them and your clients and you're thinking about keeping them and building a program, just let them know. And they really want to be involved and they want to share best practices. Don't catch your regulator off guard and they come in and had no idea this was going on and they didn't come equipped with the right staffing to appropriately measure and review your program, and it becomes a big thing and nobody wants to go through that. You want to really hone in on the attention span of key stakeholders. So it's their jobs to be really involved in programs and understand them, but their attention span is typically short because of all the other responsibilities. So make sure that whatever you're reporting on, whatever you're trying to deliver to them is concise and meaningful information in your report. Data graphs and enforcement actions, giving them lessons learned from other institutions really speak loudly to the board. Board of Director training, they have the ultimate responsibility for the safety and soundness of the FI. The training needs to be clear, concise, and specific, and they need to acknowledge that they understand it and they need to sign off on it. Employee training, each employee training should have the line of business specific training. So if it is lending, it needs to be lending related. If it's first line of defense and anywhere like that, just hone it in so that it's meaningful to that department. The first line of defense, if you take anything away from this slide, the first line of defense owns the risk. It's not your BSA department. And it's BSA's department to help mitigate the risks, but you really own the risks, right?
Yeah, first line of defense is operations and all lines of businesses in your organization. So remember, you own the risk, you have to manage and control it as well.
Right. And then you really want to define who owns the process, overall process for the higher risk banking program. So an organizational chart is really important for defining who really owns, and the processes need to be laid out of how the workflow is going to work internally, from onboarding to or verification to ongoing compliance to who's going to open the account, who's going to have the communication standpoints. It's really important to set SLAs between departments too, because you don't want to sacrifice your customer experience because the organizational chart didn't lay out the responsibilities of when stuff should be done as well. And then all in setting the right expectations with prospect clients. If you don't set the right expectations prior to them onboarding, or if they already are an existing client that you have identified, you need to give them the chance to understand your program requirements, so that if you don't set the right expectations with them from the very beginning, you are not going to have a compliant client, and it's going to be difficult to manage them, and you're not going to get the information you need to properly vet them.
And as a compliance officer, I always say, partner with your first line of defense. Give them the talking points, because sometimes they feel comfortable having those conversations of collecting personal information and asking more questions that they've ever asked before. So give them the talking points so they feel comfortable in talking to the customer.
Absolutely. And then understanding the staffing needs. We talked about this earlier. Do a staffing assessment, understand what you need to run this program, and understand that sometimes software does aid in the need for a big staffing acquisition prior to you onboarding it. We just have so many slides in here with good information, and I don't want to keep everybody.
It's good information them to hang on to.
Yeah, absolutely. So we can send this slide deck out with the webinar, so you guys have all of the information to sit down and digest, and you're welcome to reach out and ask for any additional information that you may need. But understanding your ongoing monitoring and regulatory requirements are really important. We can we could probably speak a whole nother webinar on that. But you're responsible for conducting additional due diligence, not just at onboarding, but ongoing out through the life of the relationship with that client. So again, the risk levels are always evolving, and maybe less or greater than when you initially onboarded them. If you fail at your ongoing monitoring and regulatory requirements, which is the 5th pillar of BSA, if you fail here, you fail your safety and soundness.
And it costs more to fix your program, because you either pay civil money penalties, or you have to now do look backs and hire third parties to help conduct a review of your program, etc. So it turns out to be more costly.
Yeah, absolutely. So thank you guys for your time. I'm sorry that we went over, and I'm sorry we didn't have time for questions at the end, but you're always welcome to shoot any 3 of us any questions that you have. This is just a little glimpse into RiskScout here. We have a software that helps solve a lot of the issues that we talked about today.
You know what that means, Kristen? We went over and we had all these slides. That means that this is the topic that it merits a very serious discussion and a very serious overview before you think about taking on the risk. Mm-hmm. So I think we could talk about this for days and months and weeks, right? But the thing is, you fully have to understand the risk, and you have to understand your reserves. You have to understand the technology. You have to have the right staffing, and you have to factor in negative news. We have a story about negative news where we found a chairman of the board is fighting the case right now. So that actually had an MSB account open with the bank that he was the chairman of. So it's things like that that you have to be aware of. I think this is a great topic, and if we have a second webinar, definitely would love to be a part of it, because there's so many things that you can go down a path to identify risk and see if this is the right product for your institution.
I agree. And as compliance officer, have a seat at the table. I'm sure you've heard this before, but if you overhear conversations in the elevator, in the break room about, there's a merger and acquisition, or there's new products being introduced that are considered high risk in delivery channel purposes, invite yourself to those meetings. Invite yourself and sit there to understand what's going on so you can start identifying the risk and present it to everybody involved.
Absolutely. Rita, you want to plug RAD for a second here?
Well, RAD, we do everything high risk. We do MSBs, money transmitters, ATM, cashless ATMs, pooled investments, foreign currency, you name it. We've been fortunate enough to have a staff that has years of experience in all of those areas as far as implementing, monitoring, gap analysis, best practices and recommendations, and also providing fractional support. Just to segue back to that statement I made earlier, sometimes it's not in your budget to have staff, but you may be able to get a third-party vendor that can give you fractional support until you make that decision. And that's something that RAD can definitely assist you with.
Amanda?
All righty. Well, thank you, ladies, so much for all of your insightful information. And just want to let all the registrants know that you will receive the link to the webinar via email. You can also see this webinar along with the slide and everything that was shared today later on the RiskScout YouTube channel. And we would just like to thank you for joining us today. And we sure do hope that you will join us for future webinars. We hope you enjoy the rest of your day. Again, thank you, Kristen, Rita, and Elizabeth for taking the time to share all of this really great information today. I hope you all have a wonderful day and a wonderful week. Thank you, ladies.